China's economic disaster, local government debt. Events summary January 7, 2025. Overview. China is currently facing a profound economic challenge characterized by a local government debt crisis. This situation has emerged as a significant contributor to the broader economic slowdown, particularly after the onset of the real estate crisis in 2021. The local government debt, which amounted to approximately 41 trillion renminbi by the end of 2023, represents a staggering 32% of the country's GDP. However, the International Monetary Fund (IMF) estimates that the actual debt linked to local government financing vehicles (LGFVs) could be as high as 60 trillion renminbi, pushing the total government debt to around 117% of GDP. Historical context. The roots of this crisis lie in the historical evolution of China's fiscal system. Since the 1994 fiscal reform, local governments have assumed increasing financial responsibilities without corresponding revenue growth. Local authorities have relied heavily on land sales and LGFVs to finance infrastructure projects and other expenditures. This reliance became increasingly unsustainable, particularly as the real estate market cooled down, drastically reducing land-related revenues. Key developments. 1. Debt accumulation. Over the decades, local governments accrued significant debt through LGFVs, which were established to circumvent borrowing restrictions. This model worked well in times of rapid economic growth but has now resulted in a precarious financial landscape. 2. IMF warnings. In late 2023, the IMF raised alarms about the potential risks posed by local government debts, likening the situation to the Eurozone debt crisis, especially in provinces with debt-to-GDP ratios reaching alarming heights. 3. Party conference resolutions. The 13th plenary session of the Communist Party in July 2024 acknowledged the crisis and proposed fiscal reforms aimed at rebalancing the financial relationship between central and local governments. However, the implementation of these reforms remains limited by bureaucratic constraints and a lack of resources within the Ministry of Finance. For economic impact, the crisis has not only strained local finances but has also affected the provision of essential public services such as education and healthcare, leading to broader social implications. The banking sector's exposure to LGFV debt adds another layer of risk, with estimates suggesting that up to 15% of local banks' balance sheets are tied to these liabilities. 5. Calls for reform. Experts and analysts have put forth various recommendations for addressing this crisis. Some advocate for a comprehensive overhaul of the fiscal system, while others suggest immediate measures like debt restructuring and enhancing financial oversight. Comparative perspectives. The situation has drawn comparisons to the Greek debt crisis, highlighting the delicate balance China must strike between fiscal consolidation and sustaining local economic growth. Central government officials face the challenge of managing public expectations while devising strategies that do not exacerbate the existing financial woes. Potential solutions. 1. Debt restructuring. As local governments struggle to meet obligations, restructuring existing LGFV loans has emerged as a common strategy to avoid formal defaults. This process involves extending repayment terms and adjusting loan conditions to provide immediate relief. 2. Public-private partnerships. Encouraging private investment in local projects could alleviate some financial pressure. However, many local assets may not be commercially viable, complicating this approach. 3. Asset utilization. Local governments might leverage state-owned enterprises (SOEs) to generate additional revenue, either through increased dividend payouts or asset sales. For central government support. While the central government has maintained a cautious stance on directly bailing out local debts, it has intervened in various ways, such as refinancing LGFV liabilities through provincial bonds. Conclusion. The local government debt crisis in China is a multifaceted issue requiring urgent attention and strategic intervention. Balancing fiscal responsibility with the need to sustain economic growth presents a formidable challenge. The outcomes of proposed reforms will significantly influence China's economic trajectory in the coming years, shaping not only local governance but also national financial stability. As the situation evolves, continuous monitoring and adaptive policy measures will be essential to navigate this complex landscape. The intricacies of China's local government debt crisis reveal several counterintuitive insights that challenge conventional understandings of debt management and economic stability. Here are some key points. 1. Debt management versus economic growth. Conventional wisdom suggests that more debt leads to higher economic growth, especially when invested in infrastructure. However, in the case of China, local governments became over-reliant on land sales and debt-financed projects to stimulate growth. This reliance backfired when the real estate market cooled, leading to a significant revenue shortfall that jeopardized both local and national economic stability. Thus, instead of spurring growth, excessive debt became a source of systemic risk. 2. Sovereign versus local debt. There's a common assumption that local government debt can be easily absorbed by the central government, treating it similarly to sovereign debt. However, the Chinese government has been reluctant to explicitly acknowledge this debt as sovereign. This indicates a nuanced understanding of moral hazard. The fear is that bailing out local governments could encourage reckless borrowing and spending in the future, undermining fiscal responsibility at both the local and central levels. 3. Financial sector exposure. It might be expected that a well-capitalized banking sector could absorb local government financing vehicle LGFV debts without major issues. Yet the reality is that smaller regional banks, which are more vulnerable, have significant exposure to LGFV debt. This presents a paradox where the smaller banks, often perceived as riskier, hold a larger proportion of the debt, increasing systemic risk rather than mitigating it. 4. Public services versus debt obligations. Typically, when evaluating government debt, one might prioritize fiscal obligations over social responsibilities. In China's case, local governments are tasked with providing essential services such as education and healthcare, creating a scenario where debt obligations directly impact the quality of public services. This intertwining of debt and social responsibility complicates the narrative around local government debt, suggesting a need for a holistic approach to fiscal reform that balances these aspects. 5. Transparency and accountability. One might assume that a transparent fiscal system would prevent the accumulation of hidden debts. However, the Chinese government's attempts to manage local government debt have often been met with obfuscation and lack of transparency at the local level. This contradiction highlights how the complexity of local governance structures can obscure the true financial health of local governments, contrary to expectations that increased oversight would lead to better accountability. 6. Restructuring debt. Conventional financial advice often advocates for restructuring as a means of managing unsustainable debt levels. Yet in China's case, the approach to restructuring local government debt through LGFVs is fraught with complications, as these vehicles do not operate like traditional enterprises. They are often seen as holding companies without independent revenue-generating capabilities, making restructuring efforts less effective than one would expect in a more conventional economic scenario. 7. Fiscal reform and political constraints. The assumption might be that fiscal reform can be enacted swiftly in response to crises. However, the political realities of China's governance structure complicate this. The entrenched interests of various bureaucracies, along with the historical context of the fiscal system established in 1994, create significant barriers to reform. This suggests that the political landscape can be a more significant hurdle than economic rationale in addressing debt crises. 8. Balancing act. The expectation is that central governments can easily manage localized debt crises through direct intervention. However, the Chinese central government's cautious approach to bailing out local governments is indicative of a broader strategy to maintain fiscal discipline at local levels. This reflects a recognition that immediate solutions may lead to long-term issues, countering the belief that quick fixes are always the most effective. 9. Asset valuation and liabilities. it is often assumed that assets built during boom years will retain their value and cover liabilities in times of distress. However, many of the assets financed by local government debt, like empty buildings or underutilized infrastructure, have depreciated significantly, challenging the notion that asset-backed debt is inherently safe. This illustrates how the underlying quality of assets can dramatically influence the sustainability of debt. 10. Comparative analysis with Europe. The comparison of China's local government debt situation with the European debt crisis may imply that similar strategies could be applicable. However, the unique characteristics of China's political and economic system, such as the centralized control of banks and the lack of a federal structure, suggest that lessons learned from Europe may not translate effectively. This emphasizes the importance of context in financial crises. In summary, the local government debt crisis in China challenges many traditional assumptions about debt sustainability, fiscal management, and the relationship between local and central government responsibilities. The unique characteristics of China's political and economic systems create a complex landscape that defies straightforward solutions and highlights the need for nuanced approaches to fiscal reform and debt management. China's local government debt crisis is a multifaceted issue that has garnered increasing attention, particularly in light of the broader economic challenges facing the country. While many of the headline figures, such as the staggering total local government debt exceeding 41 trillion renminbi, or around 32% of GDP, are well known, there are several nuanced aspects of the crisis that are often overlooked yet are crucial for understanding its implications and potential solutions. 1. Historical context and structural issues. The origins of the local government debt crisis can be traced back to the fiscal reforms instituted in 1994, which restructured the relationship between central and local governments. Local governments were assigned a greater share of expenditure responsibilities without a corresponding increase in revenue-raising capabilities. This imbalance effectively laid the groundwork for a chronic budget deficit, compelling local governments to rely on land sales and off-balance sheet financing through local government financing vehicles (LGFVs). The reliance on land-based revenues became particularly problematic after the real estate market began to cool in 2021, leading to a sharp decline in land sale revenues. This structural dependence on fluctuating real estate markets represents a critical vulnerability that many analysts may overlook when assessing the current debt situation. 2. The scale of off-balance sheet liabilities. Official figures suggest that local government debt stands at approximately 41 trillion renminbi. However, the International Monetary Fund (IMF) has estimated that the total liabilities associated with LGFVs could reach as high as 60 trillion renminbi. This discrepancy implies a much higher effective debt-to-GDP ratio of around 117%, significantly elevated compared to the official figure of 69%. The hidden nature of these liabilities means that policymakers may not fully grasp the scale of the crisis, which complicates efforts to address it. Ignoring these off-balance sheet debts can lead to a false sense of security regarding the financial health of local governments and the overall economy. 3. Risks to financial stability. The interconnectedness of local government debt and the banking sector poses a systemic risk that warrants closer examination. Chinese banks are heavily exposed to LGFV debt, with estimates suggesting that about 15% of their balance sheets are tied to these financing vehicles. This is a higher percentage than their direct exposure to property developers. Should a wave of defaults occur among LGFVs, particularly small regional banks with weaker capital buffers, it could trigger a banking crisis that spills over into the broader economy. Many discussions around the debt crisis focus on fiscal measures without adequately addressing the implications for banking stability, which can exacerbate the economic downturn. 4. The role of local governments in public services. Local governments in China are not only responsible for infrastructure projects but also for providing essential public services such as education, healthcare, and social welfare. The financial distress faced by local governments can severely impact their ability to deliver these services, thereby affecting the quality of life for millions of residents. This aspect of the crisis is often overlooked as much of the discourse centers on fiscal metrics rather than the human impact of reduced local services. The potential for social unrest driven by deteriorating public services could pose a significant risk to social stability and, by extension, economic growth. 5. Central government's reluctance for direct bailouts. While the central government has indicated a willingness to intervene and support local governments, it has been cautious about explicitly recognizing local debts as sovereign obligations. The government's reluctance to provide direct fiscal support stems from concerns about moral hazard, fearing that local governments might engage in reckless borrowing if they believe they will always be bailed out. This reluctance complicates the potential for effective solutions and might delay necessary reforms. Many analysts may underestimate the political and ideological factors at play in this cautious approach, which can impede a timely resolution to the crisis. 6. Need for comprehensive fiscal reform. Addressing local government debt will require more than mere restructuring of existing debt. It necessitates a comprehensive overhaul of the fiscal system that addresses the underlying causes of the crisis. The current system, which incentivizes local governments to prioritize short-term economic growth often at the expense of long-term fiscal health, must be reformed. This could involve redefining revenue-sharing arrangements and granting local governments greater autonomy in raising funds. However, the political complexities of achieving such reform should not be underestimated. Many stakeholders have vested interests in maintaining the status quo, making comprehensive reform a challenging endeavor. 7. Lessons from international experiences. Some analysts have drawn parallels between China's local government debt crisis and the European debt crisis, particularly the situation in Greece. However, the unique context of China's political and economic systems means that lessons from these experiences may not be directly applicable. For instance, while international organizations like the IMF played a crucial role in addressing Greece's debt crisis, China's government has historically maintained a tight grip on financial matters. Recognizing the limits of direct comparisons with international cases is essential for crafting contextually appropriate solutions that account for China's specific challenges. Conclusion. The local government debt crisis in China is a complex and multifaceted issue that extends beyond mere fiscal metrics. Key aspects such as historical structural imbalances, hidden liabilities, risks to financial stability, public service implications, central government reluctance for bailouts, and the need for comprehensive reform are often overlooked in discussions surrounding the crisis. Understanding these elements is critical for formulating effective solutions that can mitigate the risks posed by local government debt and ensure long-term economic stability in China. As policymakers navigate this multifaceted crisis, a nuanced approach that considers both economic and social dimensions will be vital for fostering a sustainable recovery. 1. Magnitude and structure of local government debt. China's local government debt crisis has reached alarming levels, with estimates indicating that local government debt may account for as high as 48% of GDP when considering off-balance sheet liabilities through local government financing vehicles (LGFVs). This places the total government debt at approximately 117% of GDP, raising concerns about potential systemic risks for the economy. The rapid rise in debt has been fueled by local governments' reliance on land sales and financing platforms to fund infrastructure projects and public services, creating a precarious financial balance. 2. Historical context and fiscal imbalance. The roots of local government debt can be traced back to the fiscal reforms initiated in 1994, which significantly shifted responsibilities to local governments without providing commensurate revenue sources. The inability of local governments to generate sufficient income to cover their escalating expenses has led to chronic budget imbalances. As a result, local governments have increasingly turned to land-related revenues and LGFVs to finance their expenditures, resulting in a system that has become increasingly unsustainable, particularly following the downturn in the real estate market. 3. Impact on social stability and economic growth. The local government debt crisis poses significant risks not only to the financial system but also to social stability and economic growth. Local governments are responsible for delivering essential public services, and financial distress could hinder their ability to fulfill these obligations. The potential for reduced public services coupled with rising unemployment and economic slowdown could lead to social unrest. Moreover, the interdependence of local governments and the banking sector exacerbates the risk, as defaults on LGFV debt could spiral into a broader banking crisis affecting overall economic confidence. 4. Policy responses and reform challenges. Addressing the local government debt crisis requires comprehensive fiscal reforms that redefine the relationship between central and local governments. Proposed solutions include debt restructuring, improved fiscal oversight, and potentially recognizing local government debt as sovereign debt to facilitate easier refinancing. However, the Chinese government remains cautious about direct bailouts due to moral hazard concerns and the desire to maintain a responsible fiscal image. The challenge lies in balancing the urgent need for reform with the political complexities inherent in altering long-established fiscal arrangements. The upcoming fiscal reforms announced in the party's plenary sessions highlight the government's recognition of the need for change. But implementing these reforms effectively remains a formidable task. 1. Greece's debt crisis 2009 to 2018. Greece faced a severe sovereign debt crisis that began in late 2009 when it was revealed that the government had been understating its budget deficit. The crisis escalated with rising borrowing costs and led to a series of financial bailouts from the European Union and the International Monetary Fund. The situation forced Greece to implement strict austerity measures, leading to significant social unrest and economic contraction. This crisis mirrors China's local government debt issues due to its reliance on external financing and the impact of fiscal mismanagement on economic stability. 2. Japan's lost decade 1991 to 2001. Japan experienced a prolonged economic stagnation after the asset price bubble burst in the early 1990s. The government responded with extensive public works projects funded by debt, leading to a significant increase in national debt. Despite these efforts, Japan struggled with deflation, low growth, and increasing public debt, which reached levels comparable to its GDP. Like China, Japan's local governments also faced challenges in managing debts accrued through large infrastructure projects during a period of economic optimism. 3. Argentina's economic collapse 2001 to 2002. Argentina underwent a severe economic crisis characterized by high levels of public debt, currency devaluation, and default on its sovereign debt. The government's inability to manage fiscal deficits and reliance on short-term borrowing led to hyperinflation and social unrest. The situation in Argentina is reminiscent of China's local government debt crisis, where local governments have accumulated significant liabilities and face challenges in generating sustainable revenue streams to repay debts, leading to fears of default and economic instability. Future outlook: predictions for China's local government debt crisis. As we move into 2025 and beyond, China's local government debt crisis continues to be a pressing challenge with implications for the broader economy and social stability. Below are key predictions regarding the trajectory of this crisis and its potential outcomes in the coming years. 1. Debt levels will continue to rise temporarily. In the short term, local government debt levels are expected to continue increasing as authorities attempt to stimulate economic growth in the wake of a slowing economy. The reliance on local government financing vehicles (LGFVs) will persist as local governments seek to fund infrastructure projects and social services, even as the central government attempts to manage this off-balance sheet borrowing. Estimates suggest that LGFV debt could exceed 60 trillion renminbi, significantly impacting overall public debt metrics. 2. Gradual fiscal reforms will emerge. The central government is likely to implement gradual fiscal reforms aimed at redefining the financial relationship between central and local governments. The 2024 Party Congress's emphasis on fiscal reform indicates a slow but deliberate shift towards more sustainable financing mechanisms. These reforms may include allowing local governments to raise new types of taxes and improving oversight of LGFVs, although significant political resistance is expected. 3. Increased central government intervention. As local governments struggle to manage their liabilities, increased central government intervention is anticipated. This may take the form of debt restructuring, fiscal transfers, or explicit guarantees for certain local debts to prevent defaults that could undermine confidence in the state apparatus. The central government will likely strive to maintain its reputation for fiscal responsibility while managing local debt crises discreetly. 4. Potential for local government defaults. While the government is expected to avoid widespread defaults on local bonds to maintain market confidence, isolated defaults may occur, particularly in provinces with high debt-to-GDP ratios such as Guizhou. These defaults could prompt a reassessment of local government financial health and lead to a more significant restructuring of local debts. The government may respond with targeted bailouts or restructuring plans, but the risk of contagion remains a concern. 5. Public-private partnerships will gain traction. To alleviate the financial burden on local governments, there will be a push towards developing public-private partnerships (PPPs). Local governments may seek private investment in infrastructure projects, which could help distribute financial risk and improve project viability. However, attracting private capital will require demonstrating the potential for profitable returns, which remains a challenge given the current economic climate. 6. Continued economic growth constraints. The ongoing local debt crisis will likely constrain overall economic growth in China. As local governments prioritize debt servicing over new investments, the stimulus effect of infrastructure spending may diminish. This could lead to slower GDP growth rates in comparison to previous decades, potentially affecting employment and social stability in the long run. 7. Social unrest and public discontent. As local governments struggle to provide public services amidst financial constraints, social unrest and public discontent may rise. Citizens may demand better transparency and accountability in local governance, particularly if the quality of essential services such as education, healthcare, and infrastructure deteriorates. The government will need to manage these tensions carefully to prevent widespread dissatisfaction. 8. Global financial market reactions. International investors will closely monitor China's handling of the local government debt crisis. Any signs of instability or failure to manage debts could lead to negative reactions in global financial markets, affecting China's credit rating and increasing borrowing costs. The government will likely take measures to maintain investor confidence, balancing the need for fiscal reform with the risks of appearing fiscally irresponsible. 9. Lessons from global debt crises. China may draw on lessons from past global debt crises, particularly the Eurozone crisis. Policymakers are likely to adopt strategies that emphasize restructuring and gradual reform rather than abrupt austerity measures. However, the unique political and economic landscape in China means that solutions may diverge from those applied in other countries. 10. Long-term structural changes. In the long term, structural changes in China's fiscal and economic systems are inevitable. The need for a sustainable fiscal system will drive reforms that address the fundamental imbalances between revenue and expenditure at the local level. Rebalancing the fiscal responsibilities between central and local governments will be crucial to prevent future crises of this nature. Conclusion. The local government debt crisis in China presents a complex set of challenges that will require careful management. While immediate measures may focus on stabilizing the situation through intervention and reform, the need for long-term structural changes is clear. As policymakers navigate these turbulent waters, they must balance the imperative for economic growth with the need for fiscal sustainability and social stability. The coming years will be critical for shaping the future of China's economic landscape in light of these challenges.